When you hear the name Hormel, you're probably thinking of those iconic brands, right? Spam, Skippy, Planters Nuts. And for investors, Hormel has always been a rock, a symbol of stability in the food industry. But right now, that giant is facing some serious headwinds. It's caught between this amazing legacy of consistency and a whole new world of economic pressures. So let's dive in and figure out what's really going on here.
So what's really at stake? Well, for 59 straight years, Hormel has increased its dividend. 59. That makes it a Dividend Aristocrat, which is basically the Hall of Fame for reliable companies. And look, this isn't just a nice little factoid. For a lot of investors, this track record is the #1 reason they own the stock. It's all about that reliable income.
But that legendary reliability is being put to the test. Just look at the company's operating margin. That's just a fancy way of saying how much profit it actually makes on what it sells. It got squeezed from a pretty healthy 10.5% all the way down to 9%. And that drop right there, that's the heart of the problem we need to understand.
So yeah, this is the big dilemma for Hormel, isn't it? A dividend king's dilemma. You've got this incredible legacy of stability on one hand and the harsh reality of shrinking profits on the other. Let's unpack the forces behind this and see how Hormel is planning to fight its way out.
And listen, this quote from an investment analysis just nails it. The key word here is unprecedented. These aren't your typical everyday business hurdles. We're talking about a perfect storm of major challenges, all hitting the company at the exact same time.
Okay, so let's get into it. What's actually happening inside this pressure cooker? Well, it really comes down to 3 big forces squeezing Hormel's profits all at once.
First up, crazy inflation. I mean, at one point, the cost of pork bellies, a key ingredient for them, jumped by 30%. Then you had massive supply chain shocks, like the avian flu outbreak, that absolutely hammered their Jennie-O turkey business. And on top of all that, you and I, the consumers, we've changed. We're all looking for better value, which often means switching to cheaper brands.
Now, to see where this pain actually shows up, you got to look at how Hormel's business is structured. It's basically in 3 buckets: retail, food service, and international. The key thing to know here is that retail, the stuff we buy in the grocery store, is their biggest segment by far. And that makes it the most exposed to both rising costs and shoppers like us hunting for a bargain.
All right, so we've laid out the problems. It sounds pretty tough, right? But Hormel isn't just sitting back and taking it. They've launched a huge strategic plan to tackle these challenges head-on. Let's talk about their modernization plan.
It's called the Transform and Modernize initiative, and it's a really big deal. You can think of it like a company-wide fitness plan to get leaner, faster, and more efficient. The whole idea is to find savings inside the company to counteract all those tough external pressures we just talked about.
So what does that actually look like? Well, the plan is built on these 5 pillars. It's a pretty smart approach, really. They're trying to protect their core retail business, while at the same time doubling down on their strengths, like food service, and investing in new growth areas, like snacking and their international business. And get this isn't just some vague corporate mission statement. They've put a real number on it. Management is aiming for at least $250 million in extra operating income by 2026. For anyone watching this stock, that's the magic number. It's the ultimate report card for whether this whole plan is working.
Okay, so Hormel has a plan to fix things from the inside. But there's another fight brewing, a huge one. And this one is happening right where you and I shop every week, in the grocery aisle. We're talking about the rise of private label, store brands. They've already grabbed 21% of the market, and in 10 years, that's expected to be closer to 30%. Think about that, almost a third of the market. And this isn't just a fad, folks. This is a fundamental change in how we all shop for groceries. And this is where things get really interesting and kind of tricky for Hormel. You've got their iconic brands like Spam and Planters going head-to-head with powerhouse store brands like Walmart's Great Value or Costco's Kirkland Signature. So, in a very real way, Hormel's biggest customers have now become its biggest competitors. Wild, right? Now you might be thinking, but store brands are just the cheap stuff. Not anymore. This statistic right here is critical. A staggering 83% of us now think store brands are just as good or even better than the big national brands. The perception has totally shifted. The game has completely changed.
So, with all this going on, how is Hormel actually doing compared to its rivals? Let's take a quick look. You can see their profitability. That operating margin is kind of in the middle of the pack. It's better than Tyson, but not quite at the level of General Mills. But here's where Hormel has a secret weapon. Check out that bottom row. Debt to equity. And this right here is a huge deal for investors. Hormel has by far the strongest, most conservative balance sheet in this group. What does that mean? It means they have very little debt. They have breathing room. They have the financial muscle to get through this tough spot without panicking, which is a massive advantage.
All right, we've gone through a lot here. The pressures, the plan, the big battle on the grocery shelf. So let's boil this all down. If you're an investor keeping an eye on Hormel, what are the key things you absolutely need to be watching?
Here are the 4 big questions. 1. Are those profit margins starting to recover and head back in the right direction? 2. Is that Transform and Modernize plan actually delivering the cost savings they promised? 3. Are people still buying their stuff? We need to see volume growth in that retail segment. And finally, what's happening with ingredient costs? Are they still a headwind, or are they finally becoming a tailwind? These 4 things will tell you the real story.
So it really all comes down to this. You have this incredible legacy of stability, of that dividend built over decades. But now its whole future hinges on transformation, on change. So the big question you have to ask yourself as an investor isn't just if the plan will work, but if it will work fast enough to protect that incredible legacy they've built.